private equity has hit the headlines in recent months as a potential buyer of some of the UK's biggest companies, most recently Morrisons and possibly Sainsbury's if rumours are accurate. Now, I've got lots of questions about the sector, which Richard Hickman of HarbourVest Global Private Equity has agreed to answer. Hello, Richard. Thanks for joining me today.
Hi, Lee. Delighted to be here. Thank you.
Now, for any of our viewers that don't know, could you just begin by explaining what private equity actually means?
Essentially, it refers to investments in private companies, i.e. businesses that are not publicly traded during the investment period. So it's typically where a third-party manager, a private equity manager, acquires a private business, or as you've just referred to, kind of takes a business private from the public market, and then works with management to create value over a 3 to 5 year period. It can be a longer period, but that's the typical kind of duration. And then they'll look to sell their interest in that company either via an IPO or to a trade buyer or even to another private equity manager at the end of that period.
Okay, so you've been spectacularly successful since your own stock market listing. The shares are near record high. So could you explain why and how you operate your business?
Sure. So we're a listed private equity investment trust. And effectively what we're doing is opening up access to private equity for a wider range of investors, including individual investors. And so what we do is we have a pot of capital effectively that we raised in 2007. We've invested that into HarbourVest managed funds. Those funds are providing access in turn to a whole range of opportunities around the world in private companies. And so what we've managed to achieve is to grow that original pool of capital more than fourfold since 2007 in US dollars. And that's purely organic. That's investment returns compounding over time. And how we've done that effectively through the HarbourVest funds, the access to those growing private companies has delivered repeated returns in terms of kind of realizations and cash flow coming back in. We've then reinvested those into new opportunities continuously. So we're a capital growth vehicle aiming to deliver that kind of compounded return over time.
Okay, now I know you don't invest directly in companies, but what do you think about when you're looking at asset allocation?
We think about cash flows and diversification predominantly. So we're looking to try to mitigate some of the risk in holding individual private companies, which can be relatively small, relatively undeveloped at the point of investment. And we're trying to spread our exposure across a wide range of different types of fund and different types of kind of sector. So that the way we do that is by investing in multiple HarbourVest programs, each of which targets a specific area, such as US buyouts. So those are majority stakes in larger, more developed businesses, or it could be Europe or Asia venture funds, where the HarbourVest fund is targeting newly emerging businesses in those geographical regions. So we try to spread our assets over a wide range of different opportunities.
Okay, well, why is it important and why should investors want exposure to private equity?
Fundamentally, private equity has delivered very strong returns, and in general, benchmarking against the public markets, private equity has outperformed over multiple timeframes, particularly over longer time periods. And so I think investors are increasingly keen to achieve some sort of exposure to private companies. And a convenient way to do that for most is by simply buying a share, or of course more than one share, in a listed private equity trust.
Okay. And for the industry, not just for HarbourVest, what does the future for look like? What does it look like?
We're seeing all sorts of developments in the industry. It's growing rapidly. It's still actually relatively small compared to the size of the public markets. So there's plenty of room for further growth. We see particularly, from our point of view, Asia as a growing market, and also new types of fund that focus on smaller buyout companies, so taking control stakes in smaller companies. That is an area that we think the industry is kind of pushing into. And also on the real asset side, not necessarily a traditional area for private equity, but companies that either are involved in infrastructure projects or running infrastructure assets, or even companies linked to those projects are attractive as well. So the industry is growing across a broad range of different areas.
In terms of sectors and geographies, where do you invest, and if you could explain why?
Sure. So we invest across a range of sectors. We take a relatively agnostic approach, other than the fact that we have a large allocation to technology, which has proven to be, especially in recent years, particularly beneficial to the fund. So we have a broad range, but we also have a top-down allocation by geography and strategy. So we're looking at trying to spread assets, as I say, around the world. But we do have our largest exposure is to the US, the world's most mature market for private investment. That is around 60% of our assets. Just over 20% are in Europe, and 15% are in Asia, with the balance in rest of world. So it's a good broad range of exposures.
What about the UK, Richard?
We do have a small exposure to the UK, so that's within the Europe portfolio. That's around 3% of NAV at the moment.
We read a lot about, as I mentioned at the beginning, that we read a lot about private equity in the press and grabbing headlines. So how competitive is the private equity space currently? Is there too much capital chasing deals?
I think that's a common kind of view of the industry from the UK press, certainly. There are certainly areas where competition for deals is relatively intense. I would say at the large cap, the larger businesses end of the market, in terms of public to privates that generate a lot of the headlines, that could be true to some extent. But also the industry, as I mentioned, is pushing into new areas, and I think in the kind of mid cap and smaller cap areas there is less competition than in the large buyout space. And I'd make the point that the dry powder, which refers to the uninvested capital that's been raised in recent years, there are large numbers banded around there. The typical figure is around, or estimate is around $2 trillion. Now, to put that in perspective, that is around 2 to 3 years of investment at a typical pace for the industry. So given that private equity managers generally raise up a new fund every 3 years or so, that is actually in line with what you would expect, given the model that the industry follows. We raise capital effectively in a 2 to 3 year cycle. So I think it may be slightly overemphasized, really, the potential for increased competition in the industry. I think there's a lot of room for growth.
Right. Okay. So, are we going to see these headlines? Do you think are they going to be as common over the next few years? If this is the normal cycle, do we see private equity sort of involved regularly in this the space over the next number of years? Then
it's difficult to say. I think managers do have the flexibility to pursue opportunities in the short term that may not continue to be available. I think it's hard to predict where the focus will be, several years' time. And that actually is one of the key benefits of the private equity model, that managers have this flexibility in terms of timing both the investment and the eventual sale. So these kind of trends have come and gone previously, and I wouldn't be surprised if we see, perhaps a year or two from now, that we're in a different environment. But certainly there's the potential for the industry to continue to gain more investor attention, I think, over the next few years. On valuations, I mean, we read a lot about valuations of companies at the moment, especially US tech. Does that have a big influence on private equity activity? I mean, certainly private equity managers are well aware of the valuation environment in which they're operating, and there are businesses that are valued at high multiples of earnings. I would say that the majority of managers that we speak to do exercise considerable discipline over the prices that they're paying and the deals that they're willing to enter into. I'd also say that it's become typical for the industry now for a private equity manager to model in their base case projections for an investment a contraction in the valuation multiple. So the multiple of earnings paid on entry, to make up a number, could be 15 times. On exit, they will plan for that multiple to decline, effectively modelling a reduction in the valuations on public markets, perhaps, that would drive private valuations. And so the deal still has to be profitable and meet the return target, even with that assumption baked in. So I think that does give us some comfort that the returns in the industry, can be sustained. Although, of course, it is by no means guaranteed. I should note a word of caution that we're purely looking back at historic returns when we make these sort of statements.
Of course. So high valuation is not necessarily a deterrent to the sector.
No, I would say it's not necessarily a deterrent, but it's something that is considered carefully by any private equity manager before they enter into a new deal.
Richard Hickman of HarbourVest Global Private Equity, thanks very much for joining me today.
Thank you, Lee. Much appreciated.